You've heard a lot of news lately about the global economy and the fact that America is, probably from now on, linked directly to the rest of the world economically. So let's explore Steve's thoughts on international investing.
At the time I left the Charles Schwab Company in 2003, I sat on the board of a local community foundation. In a finance meeting, I discussed with members of the committee that it was my strongly held conviction that that foundation needed to consider investing an increasing portion of its funds in gold, which at that time was around $400 an ounce, and they needed to consider investing in overseas markets. My reasons for this were twofold. First, I recognized that the debt situation was blooming and that we were facing an inevitable resetting of the value of our currency. And second, if the United States was the single most powerful nation on earth for the past 100 years, certainly for the past 50, what were the odds that we would sustain that position in the next 100? History does, in fact, repeat itself. And no differently than kids playing King of the Hill, nations play that too. The top of the hill doesn't often stay there forever. In fact, never does it stay there forever. I mean, let's just look at 100 years ago. Great Britain was the world's power, and it was said then that the sun never stopped shining on the empire. Well, all good things come to an end. With the financial debt brought on by World War I, the United States effectively bought its way to the top of the mountain. We were the creditor, they were the debtor. They sold us their gold, and we bought all of it. Okay, roll the clock forward 100 years. Who's the world's empire today? The United States. We have military bases all over the world at huge expense. Unsustainable expense, in fact. So instead of being the great creditor nation we were in 1920, we are now the opposite. We're the world's largest debtor nation. I know that today, like 2003, people don't feel this massive sea change that's taking place. We still live in big homes, we go out to dinner when we like, we drive fancy cars, and we spend billions upon billions of dollars on things like dog treats. So okay, I hate sometimes to put myself out as the prognosticator, but I will in this situation. In history, when the leading nation achieved the point of becoming an empire, that nation proceeded to spend all of its money defending its empire and then taxed its citizens to a point where they no longer built a sustainable economy. Then, as citizens had an entire globe to explore, they simply went somewhere new, and a new country rose to the peak, displacing the old. The best examples of this are the Greek Empire, the Roman Empire, the Spanish Empire, the English Empire, and now the United States Empire. But in this last situation, the United States is still the last best hope on earth. There's nowhere else with freedom to run. So here's my bet. Rather than repeating the historical pattern of the empire and power becoming a second-rate power to some new empire, I believe the United States will only slightly decline as the world's power as the new power of China slowly emerges to catch up. Look at the facts. Europe is in no better financial shape than the United States. In fact, in some ways, it's worse. Russia is not even remotely close to having the economic power of the U.S. or China. The Southern Hemisphere isn't developed at all. So the next 100 years of economic power will belong to the United States, migrating to China and the Far East. My friends, this isn't rocket science, and I'm not unique in thinking this. It's been talked about for a long time. But you and I need to think about how to incorporate it into our daily thinking as we create a financial strategy that we need to prosper in what I believe will be a chaotic economy moving forward. Part of this is certainly to understand and prepare to invest globally. Now, unlike investing globally in the past century, investing globally today is as easy as buying a mutual fund or an ETF. It's relatively low cost, liquid, and there's really no excuse today for you not to consider this. There are a couple key things to remember. First, people are people. The same characteristics that run deep in you and I run deep in people around the world. Maslow's hierarchy of needs is true for Americans as well as Chinese. Therefore, the things that drive business in the United States drive business everywhere. People's needs lead creative people developing solutions to meet those needs, which then leads to demand for that creative product. If the society is fortunate enough to have a government that doesn't too much interfere with this process, economies will build. Sadly, for much of the world, oppressive governments exploit their populations, and rather than letting this basic formula for economic growth work, they force their citizens into economic slavery to support the desires of the ruling class, which all too often are engaged in some form of military exercise to further oppress their neighbors. Now, I know someone in the world of our members is going to ask, why the political statement? Why this when we're talking about financial literacy? Well, my friends, I'm going to say this. Nowhere is economic reality more joined at the hip with political reality than in the developing world. As you consider investing globally, you must begin to understand the political dynamics of the country you're buying into. The economies of the Western world, of Europe and the United States, are wealthy certainly because they had natural resources which could be converted into more valuable things, thus creating wealth. But, and this is a belief of mine which I believe is also a reality and a fact, the Western world since the days of the Magna Carta have enjoyed the most individual liberty and freedom of anywhere on earth. This freedom and individual liberty caused people to find it necessary to solve their own problems, which in turn led to individuals finding creative solutions. Freedom and economic growth go hand in hand. Now, there's one glaring exception to this, and that's China. China has a communist government that places no value on individual liberty, but great value on societal need. In many ways, China today isn't truly communist, but it's much more of a blend between state-controlled communism and totally free market capitalism. Remember that China today has the world's largest middle class of consumers. In fact, so large that China's middle class is larger than the entire United States population. Furthermore, China today is in a hyper-competitive mood. Students go to school far more hours than their U.S. counterparts and face far more competition to be accepted into colleges and universities. Further, where the United States is increasingly an entitlement nation, and we can witness the recent move into national health care, the Chinese really don't care. Health care for all their citizens? Forget it. Just build infrastructure and products to sell to the rest of the world. When the Olympics were held in Beijing, the Chinese government imported massive amounts of labor from the countryside to build the required infrastructure. When it was done, they simply repatriated the workers back to the countryside. And if they didn't like it, tough. Let's recall China's history relative to ours. When we were growing up as a nation, the mantra of "let freedom ring" was our bellwether. When China grew up, they had Mao saying that the ultimate power comes from the end of a gun. Slightly different ideologies, but let's remember that China is a huge nation with an enormous population to feed. So as U.S. companies generated an average return of 8.5% per year over the past 100 years, a period in which the U.S. was clearly the dominant economic power, as power shifts from the U.S. to China, it's more likely China will experience improved growth while the U.S. reduces growth rates somewhat. And let's touch for a moment on the debt situation. China is our major creditor. Without the Chinese buying our government debt, effectively loaning us money each month, the United States couldn't pay its bills, its military programs, or its social programs. So I believe you should consider putting some of your hard-earned retained money into international investments. There are good companies all over the world, many of them traded on the New York Stock Exchange via what's called an American Depository Receipt, or ADR. In prior sessions, we've talked about liquidity, and this is a key concern as you begin to walk in the waters of international investing. Most large companies like Toyota trade plenty of stock in the secondary markets, so there's little or no worry about liquidity. But in some markets, you need to be more careful. Let's recall that in 1997, it was a liquidity crunch in Russia that brought down long-term capital. And in 2008, it was a liquidity crunch that took down Bear Stearns. So liquidity matters. As you analyze which countries to trust with your money, always keep liquidity at the forefront of your thinking. You also want to be aware of social and political unrest. While it's not common, countries do from time to time nationalize companies, and that leaves shareholders out in the dark. This just happened here in the United States with General Motors, remember, so it does happen. Most developing countries are relatively safe from that, though, and those that aren't you're already well aware of and wouldn't touch anyway. So why go overseas? Here's a quick synopsis. Number one, overseas investing opens you up to a wide range of companies whose products and services are sold throughout the world. In fact, global capitalization has surpassed the United States in total value, so opening up your investing horizons globally puts you in play with the majority of the world. Number two, overseas investing offers you some diversification against U.S. investments. Although, as I mentioned earlier, the same drivers that drive U.S. stock prices drive international stocks, but different economies do differ in their economic cycles and performance. Number three, the Chinese market is growing rapidly. While the U.S. is still the major player with a public market capitalization of over $11 trillion, the Chinese are growing and now have a market with a capitalization of almost $3 trillion. And China, remember, is just one of the international economies. As the entirety of the Far East grows and Eastern Europe develops, not to mention South America, opportunities will abound for enhanced returns. Number four, according to the CIA World Factbook, the Chinese economy is growing over 8% per year compared to the United States at around 3% per year. Additionally, China is the United States' largest creditor, as I've mentioned, and this can only serve to set up an environment favorable to Chinese investment. Number five, technology continues to make the world smaller. This isn't rocket science. I mean, you see it every day. But with the explosion in information technology, business now operates globally without much slippage. We spoke earlier about Tom Friedman's book, The World is Flat. And it is, to his point, flattening out each and every day. You compete daily with the globe. Why not capture the investment opportunities it provides? Number six, according to nationally known money manager Louis Navellier, growing regulations in the United States are forcing more and more global companies not to list in the U.S. exchanges. Many global companies want nothing to do with the U.S. legal system. Additionally, the implementation of the Sarbanes-Oxley regulations in the early part of this century materially incented global companies to not list in the United States. As a result, many high-quality global companies trade only in global exchanges. Number seven, investing globally is easy today. Many exchange-traded funds and mutual funds exist that have an investment mandate to invest globally. With these, you can participate in the globalization of the world economy without having to study the intricacies of each individual country and company. Although remember, as we've discussed in prior sessions, when it comes to investing, ignorance is not bliss. Knowing what you're invested in is a key to successful strategies. Now, for these basic reasons, I've focused on China because its numbers are and have been staggeringly good. But as late as the spring of 2010, Western European leaders are beginning to reorganize their priorities and have openly discussed reducing government programs and cutting budgets. This could lead to a more favorable climate in the European Union, so this too should be considered. With all that said, the United States is still far and away the largest market and enjoys the most political stability of anywhere in the world. While the European Union may take steps to move in the right direction, they have a long way to go to catch up with the strength of the U.S. It was said a generation ago that when the United States gets a cold, economically speaking, the world gets pneumonia. Well, that may be less true as we move through this new century, but it is by and large still true. So yes, it's prudent to consider international investing for your own portfolio. In fact, in today's world, it's almost irresponsible not to. But for my money, the bulk of my investments would still remain with U.S. companies.
So, this was a thorough discussion of why you must consider diversifying your investments to include other countries. Now Steve will switch gears to discuss deeper concepts of investment analysis. Let me ask the question, how do you, the investor, understand what constitutes a good versus bad stock? Steve will explain principles and practices that major investors use to help separate the good from the bad in terms of how to pick stocks for buying and selling. Now, once again, Steve Beeman.
My friends, right at the outset, I want to make one point clear. There are libraries of books written about investment analysis. Many of these go into significantly complex mathematics that could make a Nobel laureate's head spin. Benjamin Graham, in his seminal 1951 work, Securities Analysis, served as the bedrock information for such legendary investors as Warren Buffett. Our mission is not to provide you with the end-all, be-all information source for investment analysis. For that, you should check out the Association for Investment Management and Research and strive to become a Chartered Financial Analyst, or CFA. But for most of us, understanding the basic styles and strategies of Wall Street elites is critical as we work to build our wealth from the retained earnings we've worked so hard to save. So our purpose in this session is to build for you a foundational set of knowledge that will allow you to speak on their level when talking with investment professionals, and to better understand also the issues affecting your investments so that you have a better chance of succeeding on your financial journey. With that said, here we go. Investing can be thought of simply as buy low, sell high. The problem, of course, is determining what's low and what's high. For this, there are many dimensions of things you need to understand. I've elected to break this complex issue down into two sections. First, a series on the types of analysis that are done, and second, on the styles of analysis that are done. So let's get started on the main topics of analysis that are done by institutional and professional investors. Thankfully, as much as they seem daunting to understand, they're really not. Well, the first style of investment analysis is known as fundamental analysis. As the name so succinctly implies, this is analysis done on the fundamental underpinnings surrounding any investment. Fundamental analysis of any investment, whether it's real estate, stocks, bonds, commodities, artwork, or anything else, requires that the analyst have a thorough understanding of the investment being considered. In the industry, most fundamental analysts are subgrouped into sectors or industries. Sectors refer to broad categories of the economy into which the companies fall, like energy or consumer products. Industry membership further defines this into, and let's use energy as an example, electric, gas, nuclear, whatever. For consumer products, you'll see things like clothing and apparel, household products, and the like. The reason analysts are divided this way is fairly obvious. The amount of information required to truly understand any company and the relative issues that relate to its growth and valuation is enormous. It would be almost impossible for any analyst to be an expert on all segments of the economy. I mean, it's tough enough to track one segment. Yahoo Finance, for example, breaks companies into one of 8 sectors with around 100 specific industries. Now, at the core of fundamental analysis is the understanding of a company's financial statements, and also the financial statements of other companies in the same industry. This knowledge helps the analyst predict the relative health and prospects for the company. In the next section, we'll example some of the different things analysts look for. But basically, the analyst is attempting to determine the relative performance of the stock price of the companies they follow by determining which of the companies they follow have stronger balance sheets and income statements and statements of cash flow. For example, let's assume you're the auto analyst, and in 2007, you're considering General Motors and Ford and trying to decide which to buy. The balance sheet will show you which one has more cash, more debt, and more retained earnings to use. These retained earnings, by the way, are just like yours and mine. Retained earnings of a corporation represent its savings account. The income statement will show you which one is selling more and which one is actually making profit on the cars it sells. The link between the balance sheet and the income statement is the retained earnings. Again, just like you with your retained earnings and expenses, the remaining account is savings or retained earnings. While a company has a profit, income, and expenses, those profits are its savings and they're reflected in the balance sheet retained earnings account. The final statement to look at is the statement of cash flow. This is often overlooked by people, but it basically shows you where the company receives its cash. For example, you earned $50,000 in W-2 wages for 2010, but you borrow the same amount. Well, you generated $100,000 in cash flow, but only $50,000 of it from earnings. Well, companies do the same thing. They borrow money and repay it regularly, and this shows up on their statements of cash flow. So you can quickly see if a company is surviving through earning profits or borrowing more and more. In the case of Ford and General Motors, clearly in 2007, General Motors was borrowing more and more money to stay afloat. The problem with that is that eventually, as did happen with General Motors, no one will loan you more money. When a company that's living on borrowing money can no longer borrow it, it must survive either by spending its retained earnings or selling off its assets. If those don't work, bankruptcy follows. The job of a fundamental analyst is to understand these financial statements and the companies they represent so they can differentiate between well-run companies that both earn and will likely continue earning profit and those that don't and likely won't. The second major category of investment analysis is technical analysis. These are folks who use charts to determine whether a stock will move up or down, usually shorter term, based on the stock's own technicals. The underlying premise here is that stocks trade on emotion in the short term, and that emotion can be spotted by looking at how a stock is behaving. Is it moving higher? Then perhaps it has building demand. Is it dropping like a rock? Maybe it's overselling and due to rebound. The technical analysts have employed the most powerful computers imaginable to spotting repeatable trends in the behavior of stocks. I'm a little biased against technical analysis, not because it doesn't work, but because many firms have emerged which use this method to offer people instant riches based on day trading signals from some great computer program and its evaluation of unique trends. I touched on this in the session on expectations, but I want to say it again. I won't say it doesn't work, and I know that some people make substantial returns on investment through day trading, but many don't too. And the number who don't greatly outweigh the number who do. This success-failure ratio is contingent on two primary drivers. First, does your signal work? In other words, have you truly found a pattern of behavior of a stock that is predictive of its future performance, and also a pattern that has not been discovered by everyone else so it gets arbitraged away? And second, do you have the emotional discipline to follow this signal that you've discovered and try not to outthink it or trust your gut instead of the signal? A future session will look at how to find an investment advisor, and I talk there about how you should look for one that uses methods that can be repeated and tested and implemented. In investing, trust your instruments always. The third core area of analysis is quantitative analysis. This is a somewhat newer arena and one that I'm pleased to say I grew up in and was actually part of building. The concept behind quantitative analysis is that it's possible to design a mathematical formula, that is a model, that looks at the data contained in the financial statements, the balance sheet, the income statement, and the statement of cash flows, and the price behavior. And through those numbers, implement a formula that will generate returns over and above a benchmark, whatever that may be. It's somewhat technical in that it uses or can use price behavior as one of its inputs, and it's very fundamental in that it looks at the financial statements. But the quantitative discipline properly implemented uses no human emotion to override its inputs. If it says buy, you buy. If it says sell, you sell. Because you can build models to run on literally thousands of companies simultaneously, most models rank stocks by order of their attractiveness. So a typical quantitative model might rank stocks, for example, 1 to 100, with 1 being the most attractive and 100 being the least attractive. Further, these models can indicate selling points so that, for example, you buy a stock rated 2, and when that stock moves to 30, you sell it. By using quantitative indicators, you can test them to determine where in your rank a stock usually begins to underperform, and there you have your sell point. Quantitative analysis seems complicated, but it's really not. There is a factor that is commonly used, and we've talked about it, called a PE ratio, or price to earnings ratio. This simply looks at the price of a stock relative to its earnings. For example, if a company earns $1 per share, and its stock price is $10 per share, it would have a PE ratio of 10, meaning that its price is 10 times its earnings. We talked in earlier sessions that represents an earnings yield of 10%. Not bad. Well, using a simple quantitative model, you could rank all of the stocks in the S&P 500 by order of their price-earnings ratio. What you'd find is that generally speaking, stocks with lower PE ratios outperform stocks with higher PE ratios. So you might build a portfolio of the lower 50 as measured by PE, and there you go, a quantitatively derived portfolio. The magic, if you will, behind the strength of a quantitative model is threefold: the factors that are used, the structure of the model, and the effectiveness of implementation. In terms of factors, a good quantitative analyst will work diligently to create new factors that are more predictive than others. A simple example is that PE we just discussed. That factor is more predictive if you adjust the E side, or the earnings, for things like earnings growth rates. So rather than PE perhaps, you might use price divided by earnings to growth rates. Thus, a company that might look very attractive on its pure PE but has no earnings growth won't look as attractive as the other that has the same PE but perhaps strong earnings growth. That defines a factor. In terms of the model structure, a simple model is a one-factor model like PE. Well, it's not hard to figure out that there are more than one thing that drive a stock price. So you have the evolution of the multi-factor models. That's a complicated way to say, for example, that your model has 3 factors: price to earnings, price to book, and price to sales. Now understand that at the institutional level, models can become very complicated indeed. At Wharton Econometrics, where I worked, our U.S. economic model had over 600 variables. As we continue thinking about the structure of the model itself, in our example above, we had a simple linear model that said A plus B plus C. Well, some models are put together with very complex structures. At Chicago Investment Analytics, my partners developed something called multidimensional modeling that took the concept of linear multi-factor models to the next level. The third area that we want to talk about is implementing the model. This requires extreme discipline and a model that works in real time. A critical shortfall too many quantitative models have is that they work great in testing, but when you implement them, they fail. The reason can be that you didn't account for transaction costs, or perhaps you didn't account for the impact of your making trades, especially if you have large amounts of money, or perhaps your model was incorrectly built and had one of the many biases that plague models, two of which are look-ahead bias and survivor bias. Look-ahead bias is when you build your model and test it backwards, but assuming that you knew information before it was released. And the second, survivor bias, is when you build your model, but you didn't account for how it behaved on companies that went bankrupt or merged and are no longer around. Maybe you would have bought a number of companies that only in retrospect you realized would have gone bankrupt. The bottom line, building and implementing simplistic quantitative models is easy. Building one that works is very hard. So that's a quick look at 3 basic types of analytical styles. Many managers use 1, 2, or all 3 of them in making their decisions. From earlier sessions, I think all of you already know that I'm biased to use investment processes that are quantitative. I like that I can test them, I like that I can implement them, and I like that they don't require emotion that so often drives investing. So what about styles? What are the traditional styles you should think about? Here are some thoughts on that. As your own chief financial officer responsible for investing your retained earnings, you have to make a philosophical issue on one fundamental point. Are you a value investor or a growth investor? There's sometimes a blending of these, but your philosophy will and should generally drive your investment thoughts. A value investor is a person who looks at what has been, what is, and what might be based on how cheaply they can buy an asset. Sam Zell is a famous deep value investor from Chicago who buys businesses and real estate that are oftentimes in foreclosure. Warren Buffett is a value investor who buys companies he believes are very undervalued compared to their true worth. The core notion of a value investor is that the asset they buy will appreciate in price, not necessarily because it grows, but because at some future point, other investors will begin to see the value and they'll value it more highly than you did. Let's go to the simple example of a P/E ratio. As that's a static price-based factor, you might think of it as a value factor. So if we find a company trading at $3 with earnings of $1 and thus a P/E ratio of 3, we might like that, believing that at some point others will see that it's worth $5 or a P/E ratio of 5. So the value manager is looking for undiscovered value that will at some future point be recognized by others. The second category is the growth investor. Unlike the value investor, this person isn't necessarily concerned with how cheaply they buy an asset, but they're more concerned with how it will grow and thus justify a higher price. A simplistic way to judge a growth-oriented person is that they're looking for change over time rather than a point in time. For example, where our value investor purchased a stock because its P/E was, say, 3 times, the growth investor might not buy that stock because he believes the earnings will collapse in the near term, and that's why the stock is trading only at 3. He'd rather buy a stock at 15 times earnings with earnings growth that would support that valuation. Whereas a simplistic value model might look at P/E, a simplistic growth model might look at the past 3 years' earnings growth. In some cases, you'll see managers put these together in what are called GARP strategies, or growth at a reasonable price. In my experience, I've found value managers or growth managers tend to outperform GARP managers, and perhaps that's because they're taking a more purist look at how to value an asset and not trying to be all things to all people. The final thing that we'll discuss in this session is momentum. Now, momentum for this strategy is defined as near-term change in stock price. The power of adding a momentum indicator is clear, and there are numerous ways to do it. You could, for example, add a momentum factor like, say, price change over the last 12 months to your P/E model. This would give you a value plus momentum look at stocks. Or you could use your PE model to highlight a list of names and then overlay your momentum model to determine which is at a better time to buy. There are multiple forms of momentum that you should be aware of, by the way, not just prices. For example, earnings have momentum, so do sales. And these can be predictive of future price behavior just as price momentum. So a simple multi-factor momentum model might look at price momentum, earnings momentum, and sales momentum. This would broaden out the model. So those are the big three: value, growth, and momentum, with a couple of combinations thrown in. Before you set out to begin managing your retained earnings or hiring someone to do that for you, you should determine whether you are oriented more toward a value investor or a growth investor. Both are valid, both can be successful, but you want to watch out for a situation where you buy a stock because its growth was good, but then you switch to owning it because of its valuation. Stocks do go through cycles on the growth value chart, but I believe you should pick your poison, as it were, and decide early on if you're more value-oriented or growth-oriented. Personally, I like to think of myself as value-oriented, but when push comes to shove, I tend to behave like a growth investor.
You've just learned valuable information that gives you more knowledge and tools to better grasp how to look at the complex world of stock selection. From technicals to fundamentals and quantitative, from value and growth to momentum factors, you have just learned more than most any other financial content provider, and there's more to come.